You followed the rules. You paid on time. You built your credit. You trusted the system to measure you fairly. And yet the rules kept changing. Interest rates adjusted without your vote. Credit limits tightened without warning. Access narrowed precisely when you needed it most. If the system is neutral, why do the rules shift in one direction? If risk is shared, why does the burden feel uneven? They did not rewrite the system loudly. They rewrote it gradually. And most people never noticed when the balance tilted. This is not a story about individual mistakes. It is not about budgeting discipline or financial literacy. It is about structural design. Banking frameworks, credit scoring, capital requirements, and monetary policy evolved over decades to protect institutional stability first and distribute risk second. The rules were not broken. They were adjusted, quietly. To understand this adjustment, step back from individual transactions and examine the architecture of modern finance. Money in its contemporary form is debt. When banks issue loans, they create deposits. When loans are repaid, money is extinguished. Credit must grow to sustain stability. But growing credit increases fragility. For decades, expansion concealed that tension. Interest rates declined steadily from the 1980s. Lower rates made larger debts manageable. Asset prices rose. Households accumulated mortgages, credit card balances, student loans. Growth appeared organic. It was leveraged. Leverage rewards early participants and penalizes late ones. Rising asset values increase collateral. Increased collateral justifies further borrowing. Further borrowing inflates asset values. The loop feels productive. But loops require continuous reinforcement. When growth slows, leverage does not disappear. It remains embedded in balance sheets. This is where rule adjustments begin. Capital requirements for banks are recalibrated during periods of stress. Liquidity ratios are refined. Risk weights are modified. These changes are presented as prudential safeguards. They are safeguards. But they also redefine who absorbs volatility. After the financial crisis of 2008, regulations tightened around traditional banking institutions. Capital buffers increased. Stress testing became routine. On the surface, this appeared to protect the public from future instability. At the same time, shadow banking expanded. Private credit funds grew rapidly. Repo markets deepened. Derivatives exposure continued through centralized clearinghouses. Risk migrated. It did not vanish. Migration alters visibility. Visibility shapes perception. Most individuals assume that reforms eliminated systemic imbalance. In reality, reforms redistributed it. Consider deposit insurance. It reassures depositors that their funds are protected up to certain limits. This confidence reduces the likelihood of bank runs. Stability improves. But deposit insurance also shifts responsibility toward centralized backstops, often funded by government guarantees. Government guarantees rely on sovereign debt. Sovereign debt relies on market confidence. Market confidence depends on fiscal credibility. Fiscal credibility depends on economic growth. Growth depends on credit expansion. The circle returns. The rules favor continuity. Continuity preserves confidence. Confidence masks cumulative strain. Interest rate policy provides another example of quiet recalibration. For years, low interest rates supported borrowing and asset prices. When rates rose in response to inflationary pressures, debt servicing costs increased rapidly for households and corporations alike. Variable rate credit cards repriced almost immediately. Adjustable mortgages reset. Corporate refinancing became more expensive. The change was mechanical, but its impact was asymmetric. Institutions hedge interest rate exposure extensively. They use derivatives to manage risk. They access central bank liquidity facilities in times of stress. Households do not. When rates rise, the cost of living increases faster than wages. Minimum payments grow, and balances decline more slowly. Credit utilization rises. Higher utilization lowers credit scores. Lower scores increase borrowing costs further. The rulebook didn't change publicly, but its effect intensified. Credit scoring systems illustrate structural asymmetry. Scores are marketed as objective reflections of financial responsibility, but are predictive tools for lenders. They reward ongoing participation. Closing accounts can lower scores. Avoiding debt entirely reduces data richness. leading to thinner credit files. The paradox is subtle. To demonstrate trustworthiness, you must borrow. To access opportunity, you must incur obligation. The rule favors engagement. Most understand this after denial for lack of credit history or score fluctuations. Late realization is built into the structure. The mechanism gap widens. How do scoring adjustments influence economic dynamics? Banks rely on aggregated credit score data to model risk. If average scores decline, lending standards tighten. Tightening reduces credit availability, slowing consumption. This affects revenue across industries, influencing employment. Instability feeds back into credit risk models. The loop tightens. No announcement is required. The adjustment occurs within algorithms. Minimum payments illustrate this quiet recalibration, presented as protective thresholds. Minimums ensure consistent interest revenue while minimizing defaults. Paying only the minimum extends repayment timelines dramatically. Total interest paid increases substantially. The account remains active, generating predictable revenue. This stabilizes securitized debt markets. Credit card receivables are packaged into asset-backed securities, relying on steady payment flows. If borrowers repay aggressively, yield projections decline. If they default, risk premiums surge. The system seeks a profitable balance between acceleration and collapse. The design doesn't require deception but incentive alignment. Housing markets show similar dynamics. Mortgages extend leverage. Rising home prices increase perceived wealth. Wealth can be leveraged through home equity lines. Equity extraction fuels consumption, sustaining growth. This justifies asset valuations, supporting collateral for lending. The cycle reinforces itself. When housing prices stagnate or decline, collateral weakens. Banks tighten lending standards. Borrowers face refinancing constraints. The rules of engagement shift procedurally. Liquidity facilities reveal another layer. During financial stress, central banks provide liquidity to stabilize markets. Repo operations expand. Asset purchase programs resume. Swap lines open. These measures preserve institutional solvency. They rarely extend directly to households. Support trickles through financial intermediaries. Intermediaries prioritize balance sheet repair. Repair often precedes relief. Institutional asymmetry is reinforced. The consequence gap grows clearer. If rules adjust for systemic stability over individual flexibility, what becomes of financial autonomy? Autonomy narrows incrementally. Access to credit remains. Terms evolve. Rates fluctuate. Fees adjust. Eligibility criteria refine. The surface remains stable. The underlying leverage increases. Currency erosion adds another dimension. Inflation reduces purchasing power gradually. Even moderate inflation, sustained over years, diminishes real wages. If wages fail to keep pace, households rely more heavily on credit. Credit fills the gap left by currency erosion. Debt becomes compensation for stagnation. The system does not announce this substitution. It embeds it. As sovereign debt expands to support fiscal programs and backstop financial institutions, governments rely on bond markets. Bond markets rely on investor confidence. Investor confidence depends on currency stability. If currency stability weakens, yields rise. Rising yields increase government borrowing costs. Governments may respond with monetary accommodation. Monetary accommodation can reignite inflationary pressures. The balance becomes delicate. Delicate systems favor rule adjustments over abrupt change. Historical precedents echo these patterns. Under the gold standard, governments suspended convertibility during crises to preserve reserves. The suspension was framed as temporary. Temporary measures often became permanent. Under Bretton Woods, the dollar was convertible into gold for foreign governments. As deficits widened and gold reserves dwindled, convertibility ended in 1971. The dollar remained dominant. Its foundation changed. The rule was revised. Not loudly, decisively. Modern systems operate without metallic anchors. Their stability depends on trust in institutions and policy frameworks. Trust is maintained through continuity. Continuity sometimes requires redefining boundaries. When markets strain, collateral requirements adjust. When liquidity thins, central banks intervene. When risk rises, capital ratios increase. Each adjustment is rational. Each adjustment shifts burden subtly. Those closest to capital flows adapt first. Those dependent on wages adapt later. The pattern is consistent. Corporate debt illustrates this further. Low rates encouraged companies to borrow heavily for buybacks and acquisitions. Rising asset prices benefited shareholders and executives. When rates rose, refinancing costs increased. Companies cut expenses, often through workforce reductions. Workers absorb volatility. Corporations restructure debt. Access to capital markets creates options unavailable to individuals. Institutional asymmetry deepens. You were told the system was rules-based. It is, but rules evolve in response to stress. Evolution prioritizes systemic continuity. Continuity requires adjustment. Adjustment often favors capital preservation. Capital preservation secures institutions. Institutions sustain the monetary order. The monetary order defines participation terms. Participation remains necessary. Exit options narrow. Opting out of credit can restrict access to housing, employment, even insurance underwriting in certain cases. Opting in increases exposure. Exposure is normalized. Normalization reduces resistance. The system appears stable. Stability depends on adaptation. Adaptation involves recalibration. Recalibration rarely benefits those without structural leverage. This is not conspiracy. It is structural inertia. Financial systems accumulate complexity over time. Complexity distributes risk, but also obscures it. When strain appears, adjustments occur at the margins. Margins define sustainability. If debt continues to outpace income growth, margins shrink. Shrinking margins prompt caution. Caution tightens credit. Tight credit slows growth. Slowed growth increases political and economic pressure for stimulus. Stimulus increases debt. Debt expansion restarts the loop. The rules are not static. They are responsive. Responsiveness protects continuity. Continuity masks erosion. Erosion does not feel catastrophic. It feels incremental. Higher living costs, lower savings rates, longer repayment horizons, reduced purchasing power. These shifts accumulate quietly. By the time recognition arrives, the architecture has already adapted. The final clarity is understated. The rules were not rewritten to punish you. They were refined to preserve the system. Preservation requires stability. Stability requires leverage. Leverage requires participation. Participation binds. Binding feels like responsibility. Responsibility feels voluntary. The design ensures that disengagement carries cost, not immediate collapse. But diminished access, limited mobility, higher barriers. They did not rig the rules with spectacle. They adjusted parameters gradually. Incentives shifted. Risk redistributed. Language remained calm. Continuity was preserved. And most people continued participating, believing the framework remained unchanged. It did not. It evolved, quietly, according to the logic of debt expansion and institutional survival. Recognition of this evolution does not create panic, it creates perspective. The system operates as designed. The design prioritizes stability over symmetry. And understanding that does not dismantle it. It simply reveals the architecture that was always there. Beneath the surface, adjusting, refining, preserving itself.